Hey guys, welcome to OBC Academy. This is your SUSHANTH sir. Okay, let's start with today's topic. In the last video, we stopped till advantages of e-banking. In this video, we will learn about insurance. Okay, what is insurance? We all know general meaning of insurance. Insurance means in the general term we have to pay some amount for a company and company will pay some amount if certain event happens. This is what insurance is. Yes, that's pretty much it. What is insurance means. But in the theoretical form, you have to add some of the point or some of the words. So I'll define what is insurance now, or I'll give meaning of what is insurance. Here you may see one picture. In that we have three persons. So we'll consider one as one family and other one as a company. So here two groups are there. One is insurer and one is insured. Insurer is a company who is coming with insurance package, and insured is a person who's taking insurance. These are the two terms we use a lot of in this topic. So make sure you first learn these two topics, insured and insurer. Insurance means very simple, a contract between two parties. Who are the parties? Insured and insurer. And where insurer agrees to pay or agrees to undertake risk of another party or insured in exchange of premium. What is premium? We'll discuss that in coming slide, but premium is an amount which you pay in a monthly, quarterly or yearly. So that is premium. Based on that premium or while accepting that premium, insurer promise to pay some fixed amount on particular event. If something happens within that period, like if it is a life insurance, it will be like 30 years. Within 30 years, if something goes wrong, insurer will pay fixed amount which they agree to pay to the insured party or nominee party in life insurance. This is what insurance is. I think I explained in easy way with animation. Okay, let's move on to the next one. That is very important, functions of insurance. Okay, what is function? Functions means what does really insurance is for, what its work and what is it's for. Okay, the first insurance function is providing certainty. First, you have to know the meaning of certainty. Then we'll explain with the other thing. So what is certainty? Certainty is 100%. Or confirmation is nothing but certainty. What provides certainty? Insurance provides certainty. Insurance will provide or give a certainty, confirmation amount or confirmation value. In insurance, it provides certain payment for the loss, for uncertainty which is happen on that event. If life insurance, for example, if we lost a person, for that they'll pay some fixed amount. I'm not saying it's a worth amount, but whatever we took as an insurance, they'll pay us a certainty amount for the life loss. If you done an insurance for an mobile, if mobile is stolen or broken, they will pay certain amount for that mobile. So when that event is happening, they will give you certainty. Certainty means a certain amount for that risk. So moving on to the next one, that is protection. What insurance does? It protects you from losses. Insurance provide protection for coming losses or happening event. Insurance cannot stop the event completely, or insurance cannot stop event, but it can bear a risk and give you compensation for that loss. It acts as a protection. If we lost a life, it cannot prevent a loss of life. It can only bear the financial risk. So it acts as a protection. Okay. Moving on to the next one, risk sharing. The loss is shared by all the exposed person in the way of premium with a bit amount. That means every month you are sharing your risk to other person. So insurance act as risk sharing. So it acts as risk sharing in the way of premium. If something happens on that event, if we get a huge financial burden, it acts as a risk sharing with a premium. So as simple as that. So actually it is simple. Okay, that's it. And moving on to the next point, assisting in capital formation. Every small premium will one day become a big capital formation. When insurance company collect funds in the way of premium, it acts in two ways. One in capital formation and other one is insurance. But it only works in life insurance, not in any other cases. But make a note, it only works in life insurance. No other insurance cannot come into this category. So it only acts as a capital in life insurance. In other insurance, there is no point of making capital out of that. Before moving on to the next one, we have to learn this term, like I said earlier, premium. What is premium? A premium is an amount of money that individual or a business will pay for insurance company every month, every year, or every quarter. So that is called a premium. These are the common terms which is used in insurance company or insurer. Okay, again moving on to the next very important thing, that is principles of insurance. The first principle is principles of utmost good faith. Here the word faith is very important. Utmost good faith is something you have to trust each other, and insurance company has to trust you and you have to trust them, and you have to disclose every fact to the insurance company, and insurance company has to disclose every single fact or agreement detail to the insurer. So this is what this point says. Insurance is a contract, we already know, between two persons with a mutual understanding that insurer will pay compensation to insured. For that they has to disclose every single material, that means every single fact. As an insurer they can't hide anything, and as an insured we cannot hide anything from them. So that's the first point. And moving on to the next point, that is principles of insurable interest. It applies for both life insurance and general insurance, and we'll talk about the general insurance in coming slides. But now, principles of insurable interest. What is interest? At least we should like a person or a thing, that's called interest. Interest is like or love, that's called interest here. The insured must have insurable interest with the subject matter or with that product or with that life. You cannot insure unknown person. You cannot take insurance to somebody else's property because there is no insurable interest with that person or that asset. So if something happens to that asset or that life, you have to lose something. That means in the financial way or in life insurance, at least a life. So that's where they'll pay the insurance. Unless you cannot take an insurance with somebody else's car and claim when uncertainties happen, because there is no way related to that asset. Insured person has to incur in loss. That's where the principles of insurable interest, or it has to belong to you, or he or she has to be related to you in form of family or something. It has to be insurable interest, unless that you cannot take an insurance. Moving on to the next third point, that is principles of indemnity. This will not applicable to life insurance because indemnity is nothing but compensation. You cannot calculate compensation. In a life insurance, life does not have a fixed value. If we lost a loved person, we cannot estimate the indemnity or compensation. That's where the full amount of insurance will be claimed on that particular event. But it won't happen in general insurance because insurance company will try to estimate actual loss happen on that event, and they will only release that particular amount. I'll give an example for it. You take an insurance for your car for 10 lakh. It should value at least 10 lakh or more than that. You cannot take insurance more than the actual value. So imagine the car values 10 lakh and you're taken 10 lakh worth of insurance, and if your car met with an accident and for a repair it may charge like 2 to 3 lakhs. If you claim for the insurance party will come and check what's the actual loss which you are facing right now. Based on that they will give you claim. If your loss is only 2 to 3 lakh, they'll only provide you 2 to 3 lakhs, not more than that. Because your loss is 3 lakh, below 3 lakh, then they won't allow you to take more than 3 lakh, or they won't allow you full amount. But in life insurance, if you lost life, they'll provide you the full insurance amount. So that's why we should not consider principles of indemnity in life insurance, and every other insurance will come under this principles of indemnity. They'll only pay actual loss, not more than that. If you even took more than 1 crore of insurance for a small damage, and if your loss is like 10 lakh, they'll only give you permission to take below 10 lakh and not more than that. Moving on to the next one, that is principles of proximity causes. Proximity means an exact meaning is similar or closest. While taking insurance company will give you reasons. If you met with this reason, they'll give you claim option. If not, there is no chance of claiming amount. That's what these principles of proximity causes. The cause must be similar what they mentioned in insurance policy. Suppose in life insurance, if you took a life insurance of 10 lakh and the person suicide after like 5 or 6 years, that life insurance is considered as void or invalid, because the reason is not mentioned in the insurance policy, or they will mention these thing happens, we won't give insurance policy. Like we only give to fixed proximity causes. For this reason only we are providing insurance. Imagine if you took a fire insurance and on next few months if your goods are stolen, the possible chance is you cannot claim insurance because the proximity cause is not mentioned in insurance policy while you are doing, because that is a fire insurance. They only provide insurance only that particular event is happened, because they are mentioned the proximity cause. If something goes wrong with a fire, we will provide insurance. So here the proximity cause may not match. Before doing insurance, the proximity cause should be read thoroughly. Moving on to the next one, principles of subrogation. And here again it won't apply to life insurance. Principles of subrogation is nothing but every asset or every leftover thing after you claim an insurance is belong to insurance company. Suppose if you made an insurance for 5 lakh, if an insurance company compensate for an insurance of loss of any of your property, after you claim full amount, all right related to the property automatically get transferred to insurance company. So that is principles of subrogation. Next one, principles of contribution. If a person is taken more than one insurance policy for the same risk, you can take multiple insurance policy, like one for theft insurance, one for damage insurance, like that. But if you taken same insurance policy with multiple companies, like fire insurance with 2 other companies or 5 other companies for same amount, whenever the event is happened, the amount of loss of proportion should not cross your actual loss. Suppose you took an insurance with 5 companies for your car value is 5 lakh, and you took an insurance for 5 lakh with each company. Imagine these are the 6 companies. From every company you took an insurance of 5 lakh. Your car worth 5 lakh, but you can only take less than 5 lakh, not more than that. You cannot claim more than that amount. Suppose if you claim an amount from one company, you cannot claim from other companies, even though if you are paid premium. Or you can do like this. You can claim 2.5 lakh with one company and 1 lakh with one company, and again 1 lakh with other company, and 50,000 with another company. So you can take like this, but you cannot claim insurance more than your actual amount is. Suppose if you lost your car, 5 lakh with each company, so you can make profit out of it. Here we have 6 company and you made an insurance of 5 lakh, so 5 6 are 30, and with a 5 lakh of car you cannot make 30 lakhs. So it is invalid. You can only claim an amount of 5 lakh. That's it. Less than that. Next, principles of mitigation is trying to make it minimize. That's it. If I ask to say one word meaning of principles of mitigation, trying to minimize. Why should you try to minimize? That means insurance person must take reasonable step or must take few steps to minimize the loss or damage to the insurance property, otherwise they won't claim. Here, if you took an insurance, fire insurance, you have to minimize it by installing fire extinguishers and signs and fire extinguishers, so that will reduce the loss. Moving on to the next one, that is types of insurance. We have variety of types of insurance. First one is life insurance and second one is general insurance. In general insurance, we have other 3 types. One is fire insurance, marine insurance and other insurance. So moving on to the next one, life insurance. What is life insurance? A life insurance is a contract between insurance policy holder and insurance company, where insurer promise to pay some of amount of money for exchange of premium. Whenever the uncertainties event happen on that day, these insurance will get claim, or they can claim with set of period like 30 years or 25 years, like that. Or in the easy word, life insurance is an agreement between insurance company, so that company is guaranteed compensation for loss of life. This is what life insurance is. Moving on to types of life insurance, there are 5 types of life insurance. The first one is whole life insurance. The self-explanatory name says whole life insurance is nothing but this policy won't payable earlier than death. In some cases, some policy may have maturity date, but this kind of policy does not have a maturity date. You have to pay till the death. Whenever the event has happened, they will pay you insurance. So whole life insurance. Moving on to the endowment life insurance. In this policy, insurance company is promised to pay to the nominee on specified age of particular kids or death, whichever is earlier. Suppose if you make an endowment life policy for a kid, if he cross 18 year, that insurance policy get matured and you can claim for insurance. If that kid die before that age, insurance policy will get claim on that particular event. Moving on to the next one, joint life insurance policy. Like this name itself suggests, again, joint life insurance is an insurance of 2 or more lives simultaneously. If one person dies, other get insurance policy. So again, simple as that. Moving on to the next one, annuity policy. Unlike other insurance policy, this is quite different because it acts as a pension instead of insurance policy. When you take an annuity policy, those insurance policy will be divided into monthly, quarterly, half yearly, annually, like that. After a certain age, this policy will be given in the monthly, quarterly, or annually. This kind of insurance is useful for those who expect a regular income of certain age. Moving on to next one, that is children's endowment policy. Education and marriage are the two important things in parents' life as well as children's life. To meet these kind of big expenses, that too in higher education and marriage and all, they'll undergo with children's endowment policy. Here the insurer agrees to pay the assured amount when the event is happen or certain age. Moving on to the next one, that is fire insurance. It's a form of general insurance or a property insurance that cover damage of loss caused by the fire. That's called fire insurance. It only covers damage caused by the fire. And marine insurance provides protection against the loss of marine's danger. That means again a loss by marine or collision of ship, attacked by enemies or something like that. Whenever these events happen, they will provide insurance for the ship, cargo or freight. We all know what is ship and we'll discuss other terms cargo and freight in coming slides. Before moving on to next one, this is then again a quite important slide because many of the time ships attacked by these pirates like Pirates of Caribbean. Here again a pirate from unknown. Okay, now moving on to types of marine insurance. The first one is ship or hull insurance. Hull is nothing but main body of the ship. If the ship body is destroyed or damaged, the compensation will get paid for the ship company. Moving on to the next one, that is cargo insurance. Cargo is nothing but goods. Whenever you're taking cargo to one country to other country, there will be a lot of risk. It may be in the port, loss of goods or leakage, damage. Thus, if the cargo is damaged or destroyed, this policy can be claimed on that particular cargo. Moving on to the next one, that is freight insurance. Freight insurance is nothing but, for example, a space in the ship which is giving a rent for the ship company. If I want to place a cargo in the ship, first I have to rent a space. That space is nothing but freight charges. So whenever the goods is damaged, cargo people won't pay freight charges. So the freight charges has to be insured if the cargo is not reaching or if it is lost by damage. The shipping company won't get freight charges. So the freight on that time, the freight insurance can reimburse the loss of freight charges. So this is what freight insurance is. Moving on to the next one, difference between life insurance and marine insurance. It's a very important again. We have three insurance here: life insurance, fire insurance and marine insurance, based on some differentiation. Okay, let's start with the first one based on subject matter. In life insurance, human life is a subject. In fire insurance, physical property or an asset is a subject. In marine insurance, ship must be a subject or cargo must be a subject or freight must be a subject. In element, what are the elements which involve in life insurance? It involves protection or investment, both. In fire insurance and marine insurance, it only acts as protection, it won't act as investment. In marine insurance, same as fire insurance. Moving on to next basis, insurable interest. Insurable interest must be present at the time of making insurance policy, but it may not necessary to claim insurance policy, but that person may not necessary at the claim of insurance policy. But in fire insurance and marine insurance, insurable interest on the subject matter must be present in a both time on the making of policy and as well as claim. It affect in a both marine insurance and fire insurance. Moving on to next basis, duration. Usually life insurance will be taken 5 to 30 years or whole life insurance. Here in the fire insurance, it won't cross more than 1 year usually. In marine insurance, the policy is for one period or maybe like one voyage. One voyage is nothing but, if I say an example, India to Australia and Australia to India, it's a one round voyage. Okay, next is indemnity. Indemnity means the insurance will get paid if that event has happened on that particular period in life insurance. In fire insurance, the actual amount of loss will be calculated by the insurer. They only calculate the loss which is happened by the fire, and that's a maximum limit they can claim. The same thing will apply in marine insurance. You can only claim the maximum market value of that goods. Next basis, loss measurement. Loss cannot be measured in life insurance, so the full life insurance will be provided as a compensation. But in fire insurance and marine insurance, loss will be measured. Next basis, surrender value or paid up value. Surrender of life insurance is common because you can surrender at any moment within the period of time. They'll provide you some amount like 70% or 80% like that. It is based on how many remaining years are there. But in marine insurance, you cannot surrender insurance once it's done. Moving on to the next basis, policy amount. Policy amount is what is the maximum amount of insurance policy which you are making. In life insurance, there is no fixed amount. You can make any number of amount. It may be 10 lakh or even 10 crores. It doesn't matter, and you can go for any number of amount. But in life and marine insurance, the amount of policy cannot be more than the value of the subject. If your car is 10 lakh, you cannot cross insurance policy more than 10 lakh. That's it. And it apply in marine insurance as well. Contingency is, will it happen or not? In life insurance, the claim is 100% and it will happen. Therefore, the bond has two things. One is maturity date and the event has happened. Whichever is earlier, you get claim. And in fire insurance, you may get claim or you may not get claim, because if that event is not happen, you won't get any amount. The same thing which applies in marine insurance as well. The event is not happening on that particular time or voyage, you won't get claim. Okay, that's it guys for today's video. And if you like this video, seriously hit like and share with your friends like always. See you in the next video. Bye.